Oscar Health reports tomorrow morning before the bell, and they're expected to have a 9 to 10% move up or down based on their earnings. In this video, I wanted to go over what I'm going to be looking for in their earnings, even though they've already reported preliminary earnings report, as we already talked about in the video that I will link up above. If you haven't checked out that video, we talk about them not being EPS positive for this year and them also growing 1 billion more in revenue for this fiscal year and guiding for that in 2025. But let's get into their earnings preview. Like I said, they're expected to move 9 to 10%, expected move up or down, putting them at $15.20 or down to $12.48. Pretty good range there, in my opinion. I would be a buyer at 12.48 or $15.20 for the long term. As you all mostly know, if you're new here, I'm very bullish on Oscar for the long term. I think this is a massive company that is going to continue to disrupt the health insurance industry, and they do not need to take a massive bite out of the total addressable market or TAM to be able to make a massive make them a massive growth story. As we just talked about, 30% plus revenue growth for 2025, which is just massive. A couple things I'm going to be looking for on Oscar's earnings call, earnings call. If we look over here on visual stocks, their last quarter, Q1 2025, their total members jumped from previous Q1 2024 of 1.448 million users up to 2.039 million users. A massive, massive jump of user base and total members that are under their care. I want to see continuous quarter over quarter, so Q1 into Q2 growth. I would like to see in the ballpark of 2.1 to 2.5 million users. I would be very happy with 2.1 million users or more. And that would be a massive increase again, quarter Q2 2024 to Q2 2025. Total premiums earned, I'm looking for another big jump here, as we should see what could get this company to guide for an extra $1 billion and 30% plus revenue growth for 2025 over 2024. It would be total members growth with ICRA and ACA and ACA in general, and also the total premiums earned. We already know their medical loss ratio is going to be creeping up again. If you haven't checked out that video, it's in my description, or check the tab, or check at the end of this video. I'll post it there. We went over in depth the preliminary earnings that they reported, and basically how medical loss ratio is going basically spiked to 86 to 87% for this fiscal year. We've already seen UNH, United Health Group, and Centene also report elevated MLR levels, ratios. It's just how it is this year. And basically, the net income story that we were building here on Oscar, we're going to have to wait another year. Free cash flow still doing great, still climbing higher. You see net income ticking up in 2024 to positive. This year is going to take a back seat, obviously, due to the MLR ratios, but free cash flow has continuously spiked and continuously uptrending, which I see that continuing. One thing that I wanted to point out here was the estimates of 2.9. Actually, we'll just go on over here to, actually, they have it right here. So EPS estimate for this quarter is going to be negative 81 cents, and revenue for this quarter is supposed to be 2.91 billion. I think they come out and do 3 billion plus. That's what I think. I think they come out and do 3 billion plus in revenue, which is 30-some% year over year. As last Q2, they did 2.219 billion. So I think they come in and beat the revenue estimates of 2.911 billion and come in with 3 billion plus. And the EPS, I don't know. We don't know. They're going to be negative EPS this year, negative 81, negative 59, negative $1, and then supposed to get back to on track in 2026 as they have talked about raising those premiums to deal with and combat with that MLR ratio or MLR, medical loss ratio. Yeah, I think we can. I think we might beat EPS. I don't really know on that one though, guys. I would just forget about the EPS side of things and just look for revenue and guidance. So if we go over here, like I said, we're expected to lose uh this quarter and continuing that. But if we look at the annual, minus $1.31 is what they're estimating this year in a loss. And then they're only expecting 15 cents of positive EPS in 2026. But this range is so wide, negative 48 to a dollar, basically. I actually think they can get to what they were supposed to do this year, which was going to be around 60 to 69 cents EPS. And then if you look at 2027, they're expecting $1 to $2.25, 818% year over year growth, up to $1.40. Now, if we punch that into my high five snapshot, if we jump over here real quick, we punch it into my high five snapshot. I think, like I said, we get 63 cents next year, which would be a massive increase year over year from this year being negative to next year being positive of what we were supposed to get this year in EPS. Then we would be currently 11.42% undervalued, and fair value would be $15.63 at a 25 PE. Now, again, they're growing, they grew 30% year over year. It's going to depend on what they grow in 2026, but if they have another 20 to 30% revenue growth or more in 2026, yeah, this is going to deserve a 30 PE. But let's just be conservative here and say that we're 11.42% undervalued. Well, if we take analyst estimates for 2027, we would be growing into $35 fair value for EPS side, $35.16 in 2027, which is massive. It's basically a 3x from where we are today, and currently 60.63% fair value or under margin of safety there from 2026's value. If we look at free cash flow, beating it up down to a 5% free cash flow margin rate, which they currently have been doing, anywhere from 10 to 12%. Obviously, this year they might be free cash flow negative due to no net income, but we'll just see how that plays out. But we get a $42 fair value today, not tomorrow, not next year. Today, $42 fair value with very conservative low teens to high single digit revenue growth rates, which I think they can again grow high teens or in the 20s or maybe even in the 30s if they hit it out of the ballpark. So this is my like bear case, I would say. And yeah, I mean, it's just massive. $42 fair value, 67% current margin of safety. Free cash flow yield's massive. Price to sales ratio is a 0.37. Just silly. Your PEG ratio is negative now, obviously, because they're expecting negative EPS and negative PE due to negative EPS for this fiscal year. So overall, what I'm looking for is going to be, like I said, I want to see them come in with 2.1 to 2.1 or more, 2.1 million users or more, right? That's what I'm looking for. And I want to see solid guidance in revenue and maybe better than expected EPS for the next quarter, right? We already know that they're going to be negative for this year on EPS. They gave that to us in their preliminary. Well, here's the thing. In the preliminary, we already know that Mark Bertolini, the CEO of Oscar, he is a under promise over deliver type guy. We know this from his time at Aetna, and we know this from his time at Bridgewater, where he co-CEO'd with Ray Dalio. Again, we talked about this in the preliminary video and my other Oscar videos. Go check those out in the description below. I'll link them all there. And if you're still here, do me a favor, drop me a like, drop me a subscribe, and yeah, stick around for more content like this, guys. Super analytical content, talking about upcoming earnings, talking about my high five snapshot, giving you the best tool to get a total snapshot of what a company is worth today. So, looking for that total members to grow to 2.1 or more million. I'm also looking for less than bad guidance on EPS side. I think revenue guidance will be great. Again, they came out of nowhere and said that they're going to do a extra $1 billion in revenue this year, which is just massive. And some other things I'm looking for is just continued SG&A costs to come down. It's been like 19, then 18, now 17%. I'm looking for that to continue to tick down. I'm looking for more details around their Oscar Plus platform, seeing how that's going, and I want to know more about the ICRA expansion. I want to know how many members they're getting out of ICRA, and I want to hear a good game plan if ACA subsidies are not extended for the next 2 years, really next year, because they gave us 2027. They talked about 2027 and what we're going to get there, but we really haven't heard anything about 2026. I think they're kind of keeping it under wraps until they figure out what's going to happen with ACA subsidies. But they said 2027 they're going to hit. Mark Bertolini said that they're going to hit 14 billion in revenue, which right here they hit 14 billion in revenue. That gives us this current margin of safety today. And they were talking about 3 to 5% margins on the net income side of things. So yeah, they'd be looking at massive EPS explosive growth there as well, while probably still in the 20 to 30% revenue growth rate as well. So these are some of the things that I want to hear. We already got preliminary earnings right from them. We already know most of the story. Now it's time to really see. Let's get some good guidance. Let's see what happened with the MLRs, which with the MLRs, they can't control that. Like I said, they came out and said 86 87% MLR, medical loss ratio. United Health Group, which is the largest and the leader in this sector, came out with 88 to 89, and Centene came out with like 87 to 88. So they're actually doing better on MLR, probably because of ACA subsidies and some other things. Maybe ICRA, they're doing better there than their competition, which we love to see. We love to see as this company is the small guy. So yeah, guys, that's really my earnings preview. Like I said, 9 to 10% move here. If I had to take a shot in the dark, like I said, I'm in this name for the long term. I'm in it for the next 3, 5, 10 years, as long as my investment thesis doesn't change. If I had to take a shot in the dark, I think they come out, they beat revenue really big, and I think they come out and they give some decent guidance on some good revenue. EPS maybe a little bit better than expected. And I think that would be enough with member growth, with that user growth of 2.1 million or more, and some talks about ICRA. I think that would be enough to get this to go in the positive direction, 9 to 10% per share. Or sorry, 9 to 10% move to the high side. If we get a I don't see how they miss on revenue, because they guided for an extra billion more. So I don't see how they miss on revenue. They could, but if they miss on revenue, poor guidance, they missed on EPS, what they're expected to do, I don't know. At that point, then we probably move down that 9 to 10%, which puts us right back down in that $12 range, which again, I'm a buyer. Anything really below 20, but down here below 15, I'm an extra buyer, just because I know on the EPS side of things too, I'm getting that safety cushion. But yeah, guys, this is a $3.5 billion market cap. $3.5 billion market cap. Super small company, and they're pulling in over $10 billion in revenue a year. So margins are always tight in this area in this sector, but again, free cash flow, they proved to be able to have great free cash flow. They're using AI to drive down costs. And I think overall they're just doing a fantastic job in this sector with all the headwinds going on right now. They found a really good base between basically $11 and $13 per share, $14 per share. And I think they can stay in that range until we get some good news and more momentum. And we still might get ACA subsidies extended. If we get ACA subsidies extended, don't be surprised if you see Oscar Health move 20% a day or more. So that's all I got for you guys. Again, hit that like button, hit the subscribe if you want to see more content like this, guys. Appreciate you all. Have a great, amazing day.